This is Music Moneyball, the podcast that explores how to unlock the hidden value in music catalogues. Brought to you by Standard Innovation, the data consultancy for investment funds. Welcome back to the Music Moneyball podcast with me, Emma Griffiths, and my co-hosts Tom Mullen and Sam Morey. Our guest today is one of music's top deal makers and a name behind many of the transactions quietly reshaping the global music industry. He's a partner and chair of music acquisitions and financing at Michelman Robinson, where he advises on mergers, acquisitions, financing, and catalogue sales that collectively move billions of dollars across music publishing, recorded rights, and entertainment finance. In 2024 alone, he was central to more than $600 million in secondary catalogue transactions, likely the most of any lawyer in his space. His deals span everything from $5 million to $1 billion, involving investors, rights owners, and some of the world's largest media companies. This year, he's been recognized among Variety's music legal elite and is one of Billboard's top music lawyers every year since 2018. And depending on who you ask, he's either the most evil lawyer in the world or the most effective deal maker in music. Please welcome Michael Poster.
Thank you.
We love that. That's so good.
Yeah, somebody actually did once refer to me that way behind my back, to which my reaction was, "Muhahaha."
We thought it was particularly poignant given it's Halloween tomorrow as well.
Exactly, right. I feel I should be like wearing horns or something like that.
And to kick us off, Michael, we like to introduce our guests with a song. Obviously, we can't actually play the song, sadly, because we don't have a licensing budget. But if we could, what would be the song that you would like to be introduced with?
So my musical tastes always go back to my college days. So I'm going to pick Ain't No Right by Jane's Addiction, because it's one of those songs that just comes out and kicks you right in the head. And that's how I like to start things off.
Michael, I've really enjoyed like researching your background and your career. It's like one of the fun parts of our podcast is we get to meet some incredible people, and it was really interesting looking at your background. I think one of the topics you suggested that we cover was around how the market's diversified over a period of time, deal sizes, rights types, genres, geographical focus, and structures, and so on. So I thought let's start there. Let's be good to get your thoughts on that in terms of how things have changed.
Part of the upside of the downside of doing this as long as I have is that I've seen a lot of cyclicality in this world. Like I started doing music deals in the mid to late 90s. So because of that, I've seen different types of things kind of fall in and out of fashion in terms of what people were looking at. But certainly anybody who is involved in any kind of music acquisitions, call it before the global financial crisis, it was all just the only things people were really transacting in were really, class A, classic rock, pop, soul, active share, active copyright interest and all of that. Like you had passive interest, nobody wanted to talk to you. If you had film and TV music, nobody would even take the call. If you had hip hop, forget it. All of that stuff back then, nobody was even considering it. Okay. So fast forward then to call it like around 2000, we saw this massive upswell in interest in music investment. We started seeing some level of diversification, and we started seeing some people starting to pursue different strategies where they didn't want to chase sort of the 20x multiples for the $100 million, $200 million transactions, because they knew that the pricing was going to get too high. There was no return for them in any meaningful way, and it was more of an ego play or maybe a strategic play in a lot of ways, more than it was a sound investment thesis for many of them. So a lot of buyers, even this is back in 2019, 2010, we started seeing people pursuing other strategies, which is smaller deals, call it sub $10 million, sub $5 million acquisition, looking at passive interests, looking at producer rights, other genres outside of rock, pop, and even country, looking at hip hop, looking at electronic, metal, Christian, Latin, all of that. What it means is that you now have a marketplace that is much broader, deeper, wider, however you want to characterize it, than it's ever been before, of just about any rights type of almost any size is transactable. That was not the case 5 years ago. And I think that's fantastic. And what it means is that there are solutions for everybody who wants to be in this space, whether you're on the buy side, the sell side, or whatever. I think there's, whether you're a country producer who is looking for some liquidity, and literally 5 years ago, nobody was going to take your calls. Now you have that. And it just means that you then have different people accumulating those rights. And for the people who accumulate the smaller deals, inevitably their strategy is we're going to buy a bunch of stuff at preferred multiples on the lower, smaller deals, accumulate those into a great critical mass of whatever, ideally exit at on better financing terms first of all, get better financing in the interim, exit on a better multiple, and then, rinse, repeat, and do whatever else you're going to do. But we've seen several people successfully do that life cycle, raise the capital, deploy the capital, successfully exit, reload. And I think enough people are taking notes on what's going on right now that that's what they're doing. But at the moment, when somebody's coming into the marketplace, the real question is, what is your angle? What is your approach? How is that different than, Concord Primary Wave, Hard Review, 100, however many other well-financed, well-established competitors? What's different about what you're doing?
What are you seeing that's different? And have you seen anybody taking a really interesting technology and data approach to that? I think one of the things at least we've understood is there is a greater desire to take on some of the smaller catalogs, do some aggregation and get some arbitrage in the multiple. But it's significantly more work. The overhead of doing a deal is there actually sourcing the songs, the assets, the catalogs, which are more valuable, but perhaps more obscure, is a lot of hard effort. Have you seen anybody taking a really novel approach to using data and technology to do that?
I know a few people who are really looking at those types of solutions regarding identifying untapped revenue sources. Hey, we're seeing a lot of YouTube action in such and such a jurisdiction, but in looking at this catalog, we see that they're not necessarily registered to pick up all the revenues associated with the YouTube exploitation. That's untapped. I'm seeing in one issue that came up recently in film and TV was that there were certain mechanical royalties from foreign territories that were being paid through, but they weren't necessarily being accounted properly to the writer. So if you're buying from the writer, you have an opportunity to potentially capitalize on that and get uplift in revenues.
Yeah, but I suppose even notionally, have you seen that approach change over the past 5 or 10 years, where 10 years ago it might have been more, okay, we'll take a traditional approach to identifying, managing, and then flipping on the catalog, to now, even if you can't share the details of who's doing it?
Right. So remember, deal sourcing is always a relationship business. The whole industry is a relationship business, right? So ultimately, it has to start with the relationships among the parties here. Ideally, that the buyers and either intermediaries and the buyers and sellers, or the sellers and the intermediate, like there's some series of relationships that's happening in there, which is always fundamental to what's going on. I think the technology can be used to potentially identify untapped opportunities, which of course then you try to use your relationships to get in front of. It may be used by people to figure out there's money being left on the table, where you can then, once you buy something, you can then use it for the uplift and recover some of your price. But back to what you said earlier, you're right. Every one of these types of deals, especially the smaller transactions, requires a lot more legwork. Okay. It's often when they come to market, they're not necessarily as well organized. The files aren't in order. We don't have all the downloads from all the various payment sources, or there's things missing. And in certain genres, there's nothing at all. Like there's no paperwork, there's no accounting history, there's no documentation. We've seen that a whole bunch of, these types of things do tend to come up. And so as a buyer, one, it's more legwork and more time and transaction costs relative to the purchase price. So if you're usually paying, say, 1% of your purchase price in transaction costs with that deal, it's going to be a higher percentage. On the other hand, if you're getting it at a good price and there's a lot of uplift opportunity, you effectively kind of fold that cost in to your purchase price, and net you may be well ahead of the game once you factor in these other things. I mean, if you're paying, I'm paying 16x the current number, but if that current number is in fact deflated through ineptitude or whatever, however you want to characterize it, by 40%, by the time you right size that number, Now suddenly you recharacterize that multiple. I got a great deal on that. So
Yeah.
those are all things that kind of go into the mix.
And do you see that happening quite often? So people who have a well-prepared catalog are able to command a higher multiple versus
Oh, yeah.
those who don't, even at that low level.
But look, having the catalog well prepared and getting things in order is always helpful. It makes it look better. It makes your transaction faster, all of that. It's not just about well prepared. It's also about if the catalog's been really well managed from the point of view of making sure that all of the potential revenue streams associated with that catalog are being fully captured. Um, Certainly, there's the active management part of sync, covers, sampling, all of that kind of stuff, which can all be certainly worked. So that's another part of really good management. Um, and if you see that kind of a catalog that's really, really been well managed and really, really, really been well collected, look, as a buyer, you understand there may not necessarily be a lot of opportunities for uplift there. Other than, there'll be some organic stuff that happens simply by, just general uplift in royalty rates or general uplift in streaming adoption and, so on. You may not have quite as many ways to lever up that number.
But then at the same time, there's less unknowns, right? So if it's well managed, you've got good visibility, you actually can say, okay, well, we can justify a higher number because we've got better visibility into the revenue streams into the future.
Right. And it also supports a higher valuation, which of course supports the financing you get associated with the catalog, because your bank or your other financing sources are going to be more confident in advancing you more, giving better financing or more financing on a catalog where things look clean and all of that. It's not just a bunch of we think we can uplift this versus okay, this is rock solid. It's different types of.
Michael, are you typically buy side or sell side or a mixture of the two?
I'm buy side probably somewhere between 80 and 90% of the time. I do one or two sell side deals a year usually. So we did yeah, that sounds about right. Usually one or two sell side deals a year. And sometimes that's on behalf of a writer. Sometimes it's on behalf of a company, or somebody who we talked earlier about the secondary sales. So that's where somebody has accumulated a portfolio of catalogs over the past few years, and they're now exiting out of that portfolio, that whole group of catalogs. So we've done 4 of those deals already, and we have another one on the pipeline now.
Which is really fascinating. And I think we'd like to understand a little bit more about the model that you've created around that approach to being able to have that repeatable sale.
So basically, we set the deal up. It's not set up like a music catalog sale. We set it up like a private equity transaction. And in the world of private equity and corporate M&A, the deals are just there's a lot of elements of those deals that are structured differently than a music deal. Okay. And because of that, there are things like, uses of what's called representation of warranty insurance, and other elements that are very seller friendly that we can use to set up that transaction, in the secondary sale that makes it very favorable to the founders and people who acquired all the catalogs. And it's a very clean transaction for them. And it's relative. It's a simpler way to get things done. And we've done it now several times, and it works very well.
And I think does that speak really volumes to how the industry has evolved as well? Being able to take an asset as a pure asset class and do the preparation, make the investments with a view to turning it in 3, 5, 7 years time. Whereas it sounds like 10 years ago, that just wasn't really a thing.
10 years ago, there was an element to which it was a thing. A number of years ago, it wasn't. It existed because I remember when BMG was doing a lot of its very active roll-ups in, call it, the early to mid aughts. We were seeing them do a lot of that type of buying, and then eventually selling off as well. So we were seeing it, but I think it's become a little bit more of the business plan now. If you're a catalog acquirer, once you raise your money, you're going to buy a bunch of stuff. Ideally, especially if you're following sort of the smaller to mid-sized transaction strategy, you're going to require, 5 things, 15 things, 35 things, whatever it is, bundle it into one transaction. And there are buyers out there who don't want to buy a bunch of $10 million things. They don't want to execute all those little transactions. They don't have the bandwidth. They don't have the time. They don't want to do the cleanup. They don't necessarily even have the industry knowledge to be able to dig into the weeds that deeply. And so they want something that's been accumulated, cleaned up, it's diversified. It has a lot of things that are very attractive to an investor where they can deploy 100, 200, $300 million in one single transaction and get this nice bundle of stuff that's, very attractive to them.
And Michael, on the we kind of talked about earlier about kind of way that obviously purchase prices might actually be inflated from the core valuation, and valuations tend to be built predominantly at the moment on discounted cash flow. But how do you think that will change in the future with obviously AI and training data and so on? Are you seeing any of that come through? I suppose on your side of the desk at the moment.
Well, I think valuations are going to continue to be based on discounted cash flow, because frankly, I think that's the most sound method of valuation, and anything else doesn't necessarily make a lot of sense. I mean, some of the specific methodologies that are used in the discounted cash flow analysis may evolve, but I'm not a valuation person or an economist by any stretch of the imagination, so I can't even begin to scratch the surface of the intricacies of that. And I do not want to sell short the level of sophistication that really good valuation people bring to this. But I could certainly see where they could be using that AI to do something associated with what they do.
Yeah, it was more about the revenues from AI. So if you see like the deal that's been done today, I think with Universal, and how that's going to generate a revenue stream. I suppose I'm not quite sure if that's been sort of nailed down, but I suppose it can follow a similar model.
Well, I think that's actually a key question, which is what is the payment model going to be for AI uses? Okay, whether it's opt-in, opt-out, whether it's I know a couple of people in the space have dug really deeply into sort of the attribution concept of how much when AI is making a new song, to what extent is that creative process attributable to various types of works, and to what extent and to what degree, et cetera, and allocating payment for some sort of credit based on that, and having the payment flow from that, which I think is the more I hear about that, it seems like a very sensible approach, because not all pieces of music are created equal. And I think there should be some level of credit that is given to the songs that are the most influential in the creation of the song, in the creation of the AI work, right? So now how that's going to translate into a payment model, I think remains to be seen. I think it's a critical question. How that's going to unfold. I don't think anybody wants to do a sort of a compulsory license type model. Well, certainly nobody on the rights holder side wants to do a compulsory license type model. Nobody wants to do a regulated model. Certainly nobody on the rights holder side wants to do that. So I assume it's going to be some kind of a negotiated model, and it's just a function of how that gets negotiated. But I think devising that payment model is going to be one of the critical issues facing music economics. Honestly, it may be the most critical issue facing music economics right now.
And is that something that fills you with joy or dread when you think about that as a future deal that you're going to have to help negotiate around, paper around?
Well, look, I think anybody who's been around the block in this industry knew that something was going to have to get negotiated. Okay, trying to have any of this be implemented by courts or by various branches of government, I think is a bit of a fool's errand, because we've seen a lot of the shortcomings, what happens when people who don't live and breathe this industry, or don't really understand the technology, or don't really understand economics, try to do this stuff as, like I said, as a judge, or, a member of Congress, God help you, or, whatever it happens to be, right? So I think the industry coming together is inevitably going to create a better solution. I think the Music Modernization Act is a great example of that, where people from the industry came together and found a solution where the economics worked and the systems worked and the processes worked. And I mean, look, it's not flawless. There's certainly issues that any number of people have pointed out, but it is ultimately a reasonably good system, and it's certainly a lot better than what we had before. Okay. So I think what we have is, there's a bit of a negotiation at gunpoint going on here because there's all this litigation that was flying around. Which was increasing on a daily basis. It was not going away. And so there needed to be a negotiation. And yes, it was in the context of the litigations that were pending. But I think a negotiated solution is the only viable answer here. How that, again, translates into actual economics remains to be seen. And I think inevitably, whatever the first solution that anybody comes out with is not always going to be the best solution. Okay. Are people going to pattern after it? Of course, because it's easy. Oh, you did that deal with Universal. I'll do that deal with so-and-so. Right. So it may be the most convenient solution going forward. But, I think as we've seen, certainly in like digital music from like the Spotify versus SoundCloud versus, Apple versus other kinds of models, it's not always the first isn't always the best, and the simplest isn't always the best. It may not be the most fair. It may not be, all of those things together. But I think you got to start somewhere. And I think hopefully this will be the basis for a framework for that. Where that actually goes, I think we're all interested to see it.
Is it coming up in any of your like conversations with clients or buyers or sellers on your side at the moment?
It's these kind of conversations. It's a relatively theoretical conversation at this point because we haven't actually, first of all, we haven't seen what the framework is for payment. And no matter what the framework is, then we need to see how much it's actually showing up in an accounting statement. Okay, hey, we devised this terrific payment, blah, 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 blah. 30 guys from MIT and whatever, came together and came up with this thing. Fine. What does it actually turn into from a dollar's point of view? Okay, how frequently are you getting paid? What level of transparency do you get? Are the songwriters getting paid the same way as the recording artists? Are the publishers and the labels being treated the same? Are they, how are all these different components kind of coming together? Once we actually see how it's manifesting itself in royalties and the consistency of that, whether it's level, whether it's growing, whatever it is, then it's going to really start manifesting itself or really start being reflected in the valuations. And then it's really going to be a factor in the deal making and the buying and selling of catalog. Until a bunch of those things actually come together, it's going to be fairly speculative.
And so it's not kind of affecting deal flow for you at the moment?
At the moment, no.
No. And where do you think, there's a lot of deals that obviously happen without anyone really knowing. There's some public statements. Like, what's the percentage from your perspective of like what's public versus?
Upwards of 90% of the deals that happened are never announced.
Yeah. Okay, that's really interesting.
Oh, absolutely. Like I have clients. There's certain clients we've done dozens of deals for. They've never announced a thing. And honestly, in certain cases, that was a strategy because there were certain, like, okay, let's go back a few years. Let's go back 2019, 2020. Starting back then, we were starting to see certain buyers who were very, very public about what they were doing. Now, part of it was because in certain cases, they were publicly traded companies. It was going to come out anyway. So you might as well seize the opportunity as opposed to not seizing it. But there were certain buyers who were being very, very public about what they were doing. Okay. For the sellers, in certain cases, that created some discomfort. For a lot of people, they're perfectly happy not to have the rest of the world know that they've done this transaction. Like, take the money, bank it, do something with it. I don't want people showing up in my house. I don't want people, hitting me up. I don't want, cousins asking me for loans. Whatever. I'm cool. And so there's, I would say, yeah. And realize the other thing to remember is this, that for every one of the big high profile deals that we see announced in the trades, for the, these are 8 figures, 9 figures kind of transactions, or at the moment, even like 10-figure transaction, which has been, coming around in the trades a little bit recently. There are exponentially more, call it sub $10 million deals that are in the marketplace every single day. And by the way, that's what actually feeds the strategy we talked about earlier, which is why do people pursue smaller deals? Because just by basic economics, when you have a lot more supply, the inherent economic impact is that it reduces price. So that's why you can get better pricing on a $7-8 million deal than you're going to get on the $70 or $80 million deal, simply because there's much more of them and there's perhaps less competition for it.
Do you think, like, in the next 5 years, do you think that there'll be less supply, or do you think it'll be broadly the same? I mean, you're pretty close to this, Michael, so it's interesting to get your thoughts.
I don't know if there's less supply. I think it's going to be different supply. Okay, so let me give you an example. Okay, so like over the last 5 years, there was a huge feeding frenzy of people buying, right? So are there a lot of like really great classic British rock catalogs that are floating around out there that nobody's bought yet? Not that many. Yeah, are there some? Yeah, I mean, look, I could sit here and come up with a couple of names off the top of my head of nobody who's traded or nobody's done anything. Fine, okay, but there's certainly not as many as there were, and a lot of people took advantage of that market appetite to sell. Okay, so are there still things in the marketplace? Absolutely. Are there still some of the older things? Absolutely. But I think what we're going to now start seeing as part of the broadening of the market is more and more buyers looking outside of classic English language rock, pop, soul, right? That's where we started, right? Of they're going to look at EDM, they're going to look at, Mexican regional, they're going to look at continental Europe, they're going to look at, Japan and Korea and India, sub-Saharan Africa. They're going to look at different, whether, for years people have like been turning their nose up at producer deals. God, I hate producer deals. I hate them because they're a real pain in the neck to get them done. If you know how to do them and you really have the infrastructure, it's a deal structure that can work. And when the rest of look, my theory is always, if the rest of the industry is turning their nose up at an asset, that's the asset I want to look at. Because again, supply and demand. And nobody else wants it. Fine. I'm the only game in town. I'll take that at an 8 times multiple. Done. And yeah, if I have to do some legwork and I have to build out some infrastructure to do it, that's fine. But I was on a panel discussion earlier this year, and the exact same dynamic came up where I was on the panel with 3 other people, and the moderator said, "Okay, what kind of music rights would you want to invest in?" The first 3 people all said publishing, and I was like, "I want NIL. I want other genres. I want I want everything that they're not looking at, because if this is a microcosm and 75% of the market is chasing that, terrific. That means I got everything else to myself. I got no competition.
Yeah.
That's just my business."
That's the Moneyball thesis, right? Right there. Like,
That's right. I mean, and look, if you have catalogs that you can buy, does the catalog itself get spinned a lot? Not necessarily. But if the catalog is getting picked up in samples, like it's like sample bait, like other people, and you're getting the second life on these songs over and over and over again, remixes, new use, like that's gold. I mean, yeah, does everybody want that shot in the dark, 1 in a million sync? Like if you can get, running up that hill, like on Stranger Things, which suddenly that song, like, right? Look, we'd all love that. Okay. Every catalog owner wants that, and every catalog owner will do pretty much anything to get that kind of a placement into a top show. That's a 1 in a million shot, and that's probably being generous. Okay. However, the ability to take, an old, an alt rock song from 1981, then remix it as part of a brand new EDM song or a pop song or a hip hop song that's going up the chart, there's a huge value unlock that can happen there. And that's just A&R and creative and all of that. And I think that's also, again, part of these strategies that people are going to start to employ. That's where you really get, where the value of the creative team really comes into play as a buyer. It's not just, the buyer doesn't necessarily need to be a bag of cash with a bunch of analysts. I mean, if you had that creative engine and the ability to work that creative side, that unlocks opportunity.
Do you think there'll be some kind of consolidation? So where I'm going with this is there's been a lot of buy activity in the past 5 years, which you mentioned. Clearly, there's like aggregation that's happened there. So with liquidity events coming up, do you expect there'll be catalogs that have been aggregated that will change hands more so in the future?
Yes, is the answer. Okay, is that I think if you're dealing with one of the very large asset managers, right? Apollo, BlackRock, Carlyle, if those guys are only transacting in deals that start with a B most of the time, right? So, but if you can accumulate, a whole bunch of these different portfolios and a whole bunch of these catalogs in a very diversified way, and that's the kind of thing that that's attractive to the very large asset managers or pension funds or whatever. And so, yes, I think the inevitable result of this is that there will be a certain amount of that there will be, like Hypnosis was, and others were as well, of these very large, very diversified catalogs that are the product of lots of other people's acquisitions that all happen. But the beauty of this industry is there's new music being created every single day. Okay. There's one client who I work with where we sold his first catalog in 2019. 5 years later, we sold the second catalog. What was the second catalog? All the stuff he'd written since 2019. Okay. And chances are in 5 years, we're going to rinse, repeat. We're going to do the same thing all over again. Music is constantly being renewed. It's constantly coming up. It's constantly being created. And the beauty of that is that it creates new opportunities every single day.
And with that volume of transactions, are you seeing, we already talked about you having a model, an approach to do it. Do you think the overhead of doing a transaction is going to decrease over time? So it actually creates less friction, which will create more liquidity, which will create more opportunity?
I do think the transaction costs are going to go down in certain cases. I think AI will help that in terms of be using AI to do things like royalty analytics and some aspects of legal due diligence, and some things like that can be time consuming and expensive. So I think there will be some aspects of that simplify things. There's still a deal to be negotiated, so there's still going to be a contract that needs to get hammered out with allocations of risk and contingencies and payments and so on. And as far as I know, there's no chatbot that's quite able to do that yet. But I think that will lead to some simplification. But remember, with all this AI stuff and with all technology, it's garbage in, garbage out, right? So if somebody comes to the marketplace and they don't have all the royalty statements, or they're in crappy format, or they're not in the right, you don't have all the information and all that, it's inevitably, the AI or whatever can only process what it gets. And that's assuming that those things are of decent enough quality. If there's giant holes in it, then you're going to get terrible output, and it is what it is. That said, I do expect some level of simplification and efficiency will come out of that.
Should we move into the quickfire rounds?
The lightning round. Okay.
All right, Michael. What is the one song or album that is just stuck on repeat in your phone playlist, whatever it is at the moment?
At the moment, I've been re-listening to Mother Love Bone's Apple album. There's a couple songs in there that absolutely just crank. We play them in the car and love them. So that's the current thing in the mix right now.
Love that. I feel like we need to do a playlist for this for our audience, because it's just going to be so varied and mixed. Like, it's just brilliant.
Right, exactly.
And yeah, Michael, what's your most memorable gig?
So before I was in law, I was a stagehand in the concert business. So I spent 4 years as basically like a guitar tech and a steel rigger and a stagehand and all of that. So I worked in concert. So I got to see actually a lot of really, really fun shows. The back and often from either backstage or under the stage or whatever. So I would say like the best show I ever worked on, and the most memorable, was a New Year's Eve show I worked on. This would be like New Year's Eve, like 1992, I would say. My timing, I may be off by a year or so. It's all blur. But there were two opening. This was in a small theater in New York City. It was a televised concert. The opening acts, as I recall, were Lenny Kravitz and Pearl Jam, and the headliner was Keith Richards' solo band, which Keith Richards around that time period put up a solo record of super bluesy material with his own band, and it's an awesome album. It's called Main Offender. It's a fantastic album. It's actually one of my favorite albums of all time. So, but it was, like I said, it was in this very, very small venue. Bill Graham was there. He was like the promoter. I mean, there's a lot of music royalty kind of stuff going on there. I was 20 years old, carrying, like a C-wrench and a claw hammer, because I was staging. And what did I know? But all I knew is that basically I was literally right in front of the stage the whole time and just having the time of my life.
So cool. Yeah, I tried to get into the roadie side of things. I actually went to roadie school for a year and got a roadie diploma.
Really? Is it printed on the side of a road box? Is it like written in Sharpie? Right.
Next question, Michael. What's your biggest pinch me moment? And I feel like you're just going to have so many. This is going to be really hard. But like, is there one that stands out particularly?
Again, I'm going to go back to my roadie days, because that was when I had some cool experiences. I was working on a U2 show at Yankee Stadium. This was on the Zoo TV tour. And I'm standing next to, right next to the soundboard at a big outdoor show. There's this area that's sort of, roped off, fenced off for the VIPs. But in the as stagehands, I mean, you may be familiar with this term. We used to call it the poser deck, right? So like, there's a bunch of people, a bunch of VIPs standing on the poser deck, and I'm sort of standing next to the deck because we were on for the show call, and somebody bumps into me really hard from behind, and I turn around like, "What's up?" It's Phil Spector. Okay, so now he was cool, and so he was like, "Oh, you're a stagehand. You have all access. I have all access. Can you take me to U2's dressing room because I'm supposed to have drinks with them?" Sure. So we had to kind of go the long way around. This is in Yankee Stadium. So I'm literally walking with Phil Spector through the bowels of Yankee Stadium for like 15 minutes, like chatting with him. I'm 19. Okay. And walking with him, like just asking about stuff and talking about stuff. He's like, "Oh, you should come in and have drinks with us." And blah, blah, blah. I'm like, I was completely like, because like at the time, like I really was a huge fan of his, like, I thought I wanted to be a producer at the time, or really wanted to get into, more of the sound mixing side of things. So like, I'm like sitting next to like one of the gods of music production, the wall of sound himself, right? But anyway, we ended up having this very funny conversation. And what really blew my head was that I had actually met Phil about 2 years earlier. Because I was at some other show where I was completely hammered. And I staggered up to him and I said, "Hi." I'm like, "I am." And I said to Phil, I'm like, you and I actually met once before. He's like, "Oh yeah, it was like 2 years ago." And I still had almost a photographic memory for that, which I had no idea about. But I was like, "Holy crap!" I hope I didn't say anything really offensive. But it was very. But that was probably about as close to a pinch me moment I could come up.
Yeah. Wow. Amazing. And if you could own one song, Michael, and get the royalties, it doesn't have to come from a place of greed, but if it does, what would it be, and what would you go for?
I would basically own anything on Exile on Main Street by the Stones. That's again one of my favorite albums of all time. So I would take it like a tiny little piece of anything that's on that album. So that would be sort of top of my list.
And last but not least, what do you think is the most underrated opportunity in music rights investment?
EDM.
Oh,
EDM.
that's a hot take.
There is no genre of music that is more global. You put on something at 180 beats per minute, and with the right bass lines and the right production or whatever. And by the way, this could be this is the kind of stuff that people can create like on their desktop, like right here, right? There is no people will dance to that music, whether they're in Busan, Dubai, Rome, or Peoria. It doesn't make a difference. They'll still dance to it, and they'll still appreciate it, and still listen to it, and they'll still groove with it. It is the most universal form of music. I think there's a huge live experiential element to that genre. There's the whole DJ, like the outdoor DJ performance world, which in the US isn't as much of a thing, but like you get to Europe and it's monstrous, right? People filling 200,000 people in a stadium to watch somebody spin. To me, I think that's the biggest opportunity. Now, look, that's a genre that's generally, it may not trade as high a multiple. I mean, the valuations are going to be different because the performance is different. It works differently. Okay, I get all of that. That said, I think it is largely untapped, and it's a tremendous opportunity.
Amazing. Well, what a place to end. And I'm so pleased that it wasn't K-pop. We're finally getting away from K-pop.
Yes. No. Yes. I'm sure Golden from K-pop Demon Hunters will be 20 years from now. People will be singing that for karaoke. But yeah, or maybe not. Maybe they'll forget about it in 6 weeks. We'll see.
Well, thank you so much, Michael. That was super interesting and
my pleasure.
Excellent to have you on the podcast.
Thank you.
Thanks very much.
Thanks for tuning in to Music Moneyball. If you enjoyed the conversation, you can subscribe at standard-innovation.com to get every episode in your inbox. You can also follow the show on Spotify, Apple, or YouTube to stay ahead of the curve in music rights investment.